Hi everybody, this is Rushabh here. We welcome all of you to the fourth quarter call for Karma Capital. We have three people who will be speaking today. Myself, I'm the co-founder and co-CIO of Karma Capital. I have my two colleagues Vinay and Ekta who will present after me. I will start with giving you some update in terms of our views on where the current market situation is, also how our portfolios are positioned, and post that two of my colleagues will take you through our various strategies, including Karma Wealth Builder, which is our flagship strategy, which has been in operation for 19 years now, and of course some of our newer products which we have launched over the last 3 years. So from my perspective, I want to start today giving you some idea on where we stand. We've seen a lot happen in the markets in the last 6 months. And what we've tried to do in today's presentation is to put forward key themes, both from market standpoint and our portfolio standpoint, and how our portfolios are positioned to what we believe is going to be a new cycle from a market standpoint. And I think that's something that we will talk more in detail about. So if you look at our track record, and why karma is a question that we keep getting asked. Not a lot of people know us in the domestic market, though we have been around for almost 20 years now. From our perspective, Karma has had a very long track record at Karma Wealth Builder, which is our flagship product. Over the last 5 years, we've delivered 11% alpha for our investors. We've also low churn from our perspective. Churn is less than 30%. We run a high conviction portfolio. Sector exposures are very different from what we see in some of our peers, and I will come to that a little later. Though we are an all cap strategy for Karma Wealth Builder, which is our flagship, the market cap is about 1,20,000 crores. So it's an all cap strategy, but it's not a small cap strategy or a mid cap strategy. It's reasonably large in terms of the companies that we own. Holding periods are long. Once we buy into a name, we own it for about 3 to 5 years. Right now it's running at about 5 years. So from our perspective, we are low churn, high conviction, long holding periods in terms of our portfolios. And we have the ability to think independently. The research team, some of whom you will hear today, has been with us for a long time. From our perspective, the stability of the team allows us to be also many a times contrarian, the way we think about our investing, and that also is very critical to what we do. We have generated alpha across cycles from our perspective. We've been, as I said, managing money for the last 18 years now, and we've kind of added almost 3% alpha over the 17-18 year period. We've always keep getting asked about the market environment. And I think from our perspective, we just wanted to address it right up front, especially considering what's happened in the markets over the last 6 months. Though India is in a sweet spot from a long-term growth perspective amongst the larger economies of the world, we have definitely seen a slowdown in FY25, especially in the second half. We are hoping that growth will start picking up, most likely in the second half of FY26. And I think that's something based on how we see various factors playing out. One thing we keep hearing about valuation dispersion, people talk about valuations being high in small and mid cap. Our view is valuations have been high across the range of market cap, not just small and mid cap, which is also visible in the fact that some of the very large cap companies have seen 25 to 30% drawdowns in the last 6 months. So if you look at some of the largest market cap companies have drawn down almost 25-30%. And therefore, I think, of course, the small and mid cap, because the numbers are larger, therefore you would see, and of course the market caps are smaller, you will see much greater dispersion. But we thought that valuation dispersions were high across the market cap range, that is large, mid and small cap. Markets were increasingly becoming narrative driven. If you look at most of the calendar 25, the narrative driven market was in great flow. Anything you attach, defense, capex, energy transformation, etc., AI, those stocks would start going up. People really didn't bother too much about cash flows and capital efficiency. From our perspective, that's really critical. And the fact that the market was completely ignoring that in the last, especially the second half of FY25 calendar, was a concern for us. And I think therefore we've seen some bit of correction happen, and maybe the market starting to kind of look more reasonable. As we see the overnight development, this is something that we were all, anticipating the fact that with the new Trump administration, we'll see significant tariffs, and which we've seen overnight yesterday. And we think that this will pose challenges to global growth over the next few years, unless we see a rollback in this going forward. And of course, there'll be a lot of bilateral trade agreements that will happen, which will also mean that bilaterally you will see tariffs being rolled back based on how each of the countries negotiates with US. But clearly, this is what we believe is a kind of an end of WTO, because now going forward, all countries will start to use this as a template to kind of negotiate on a bi-party basis rather than going through the WTO. So from our perspective, this is a significant change, and this is here to stay from a global growth perspective. And I think that, and how it is going to impact us is still early days. It's not going to be possible to really articulate all the impacts yesterday's announcement will have, but it's going to definitely have a significant impact. What we believe is going to happen over the next few years, we believe that the post-COVID cycle that we saw from 2020 March, when we saw the lows of COVID, to last year, is coming to an end. And it was quite visible, as we mentioned, in the narrative-driven stock price performances that we saw in the second half of 2025. Our view is that the markets over the next 2-3 years, that is in the medium term, will look very different from what it's been in the last 4-5 years. And therefore, as investors, we'll have to think very differently from a market standpoint. As we keep saying, flogging the same horse is not going to work. We will have to look at new ideas, new businesses, new companies. And in the new cycle, a newer set of businesses will do well. And that's really going to be the challenge for all the managers to kind of figure out what will be the new set of ideas which will do well. Hence, our journey from $2,500 to $5,000 per capita will be very different. I think that's something we are very clear that India has seen doubling of its US dollar denominated GDP over the last decade. We think that the next doubling will happen maybe much faster, but the next $2,500 will come from a very different set of businesses as compared to the past. And also the winners will be very different as compared to the past. We've seen markets correct almost 15%. I mean, if you look at the broader indices have corrected 13-14%. I'm just kind of rounding it off to 15%. And individual stocks correct 30 to 50%. So therefore, some sanity is starting to come back in the markets. Also, as bottom-up stock pickers from our perspective, this is new opportunities are now starting to open up to find newer ideas. Corrections are across sectors, large, mid, and small. What we want to do is to stay away from crowded trades. As I said, flogging the same horse is not going to work. There are a lot of crowded trades. People, investors, institutions have piled on in the last 3-4 years. And those crowded trades are always going to see more and more selling at every rise. So we're going to see a market in many stocks, which is basically going to be a sell on rise market. And then, of course, you'll have a time correction where you'll see a market going sideways for some time, frustrating a lot of investors who will be holding some of these names. We've seen significant FII selling in the last 6 months, almost $25 billion plus. And I think that's also responsible for the fact that a lot of large caps have seen significant corrections, because majority of that selling was in large cap companies, while a majority of the domestic buying was in the small and mid cap space. So I think the FII selling has had its impact. Counterintuitively, the first leg of the market from October to December was led by FII selling. And which is why we saw significant price corrections in the large caps in October to December. And then we started seeing that trickle down into small and mid caps in the Jan to March quarter. One of the things which we think will happen is market breadth will narrow going forward. Therefore, number of companies which will do well will be smaller as compared to what has done well in the last 4 years post-COVID. And that will pose a significant challenge to managers, because as the markets narrow, fewer companies will do well, and therefore a lot of investors will chase those few companies. But the real question is going to be identifying those few companies which will do well. So market narrowing down will pose a significant challenge, and that challenge is going to be manifested in the fact that people will find it difficult to beat the index. So I think that's going to be a very interesting phase to watch out for over the next 2 to 3 years. At Karma, we are very clear. We want to keep it simple. We want to buy companies at a reasonable price, companies with strong, predictable cash flows. We are not looking for pie in the sky kind of companies where where it's based on hope that something will happen over the next 3, 4, 5 years. We want to see predictable cash flows, and we want them at a reasonable price. That also means that we are early cycle, also that we are contrarian in terms of our view many a times when we buy into a new name, and that allows us to buy these companies at a reasonable price. So we anticipate growth, we don't chase growth. I think that's really critical to what we do from a longer term perspective. And also which differentiates us and allows us to generate this alpha. So if you're buying the same companies at the same time, it's not really going to work. You'll have to buy different companies at different points of time, and that's only what will add alpha to our investors' portfolio. What we have in our portfolios, we think our portfolios are positioned well for the next cycle, and at least we believe that. And of course, we'll have to wait and see how it plays out over the next 2-3 years, because our portfolios are different. Our largest holding is pharmaceuticals. Very interestingly, today when the tariffs were announced, pharmaceuticals have been left out by the US in terms of retaliatory tariffs. We'll have to wait and see if that continues. However, currently they are not a part of it, so the companies are breathing easy. Our view is that a lot of our companies are domestically driven, have significant domestic cash flows, and we are not really too worried on the tariffs, even if it happens, because they have the pricing power, and a lot of these guys will be able to pass on price increases if there are tariffs put in even later, and I will let my colleague Vinay talk about it a little later. Payment companies is another large holding. We think payments is a very large domestic opportunities, and if you look at what we are seeing, as we keep joking about it, we've tried to do as much of Trump-proof portfolio as we can. Companies that are not impacted by the external environment so much, have domestic drivers and are driven by what's happening in the local economy rather than export driven. Telcos, we own 2 telcos. Both of them are doing very well. Both of them very different businesses, are very well positioned. Life insurance is something that we have bought over the last 6-8 months. That's the new addition to the portfolio. We believe that after a lot of regulatory intervention over the last 5 years, our view of the world is life insurance is now poised to grow with maybe a little less regulatory intervention, and that will allow it to kind of, from an investor standpoint, make us a reasonable amount of money over the next 3 to 4 years. We have an MNC port company, we have an airlines. When we bought which is the largest airlines in the country, about 2 years ago, people told us that nobody makes money in airlines. I mean, I'm happy to say that we have doubled our money in that business over the last 2.5 years, and we still continue to remain very bullish on it. Again, we were contrarian when we bought that airlines, we were contrarian when we bought the telcos, and we are contrarian when we are buying insurance. So our portfolios are positioned for the next cycle. We don't currently have any IT, we don't have any consumer staples, we don't have any PSUs, we don't have any defense companies, and we don't have any capex companies. So this is something that we don't have in our portfolios right now. And I think that's something that always comes as a question to us, but we just wanted to kind of upfront clarify that this is something that we don't own. What's in our portfolios? What is early cycle? And we've talked about early cycle in our previous presentations to you, so I'm not going to really bore you with it, but basically pharma, telcos and autos are mid-cycle. Newer additions like life insurance and payments are early cycle. And then there are some late cycle companies which we sold out during 2024 and recycled the money into newer ideas and some of our existing ideas. So from our perspective, everything is not early cycle. We have made significant amount of money in pharma over the last 3 years, telcos and autos. We still believe that there is enough room for growth in these businesses, but clearly they are not early cycle. But something like a life insurance and payments is new. We've added that over the last 6 to 8 months. And there is a large opportunity there, which we believe is just starting to play out. So we have differentiated portfolios at reasonable valuations. That's really important. I underline reasonable valuations because it's very important that companies are not horrendously valued even today, and therefore it leaves a lot of growth from a re-rating perspective apart from the underlying business growth perspective. I will hand it over to Vinay to talk about Karma Wealth Builder, our flagship product, and then he will pass it on to Ekta to talk about our 2 newer products. Thanks so much for being patient. We'll open up the floor for questions once we finish our presentations. Thank you so much.
Yeah. Thanks, Rushabh. Talking about Karma Wealth Builder again, if you see in terms of sector allocation, the market cap allocation, currently it's around 1/3, 1/3, 1/3 across large, mid and small. And within mid cap also the preference is towards higher end of mid cap. As Rushabh alluded, again, healthcare continues to be our largest sectorial allocation, followed by consumer discretionary, Financials, again, it's a very different flavor where we don't own any of the large private banks. It is largely through insurance companies and SBI credit card, which is part of the holding. Again, we took advantage of the opportunity which was presented to us in the last, I would say, quarter to increase our allocation towards life insurance companies. And also we have exited ICICI Securities, which was the other holding, which eventually now got converted into ICICI Bank. And other than that, broadly, we don't own any IT FMCG names in the portfolio. In terms of portfolio characteristics or statistics, if you were to see from a 3-year perspective, which is FY24 to 27, if you see, we still see a decent 20% plus CAGR in terms of earnings. And post the correction again, now if you see versus the broader benchmark, portfolio continues to be relatively less expensive or relatively fairly valued, I would say, wherein there is opportunity to add further into a few of the names. So on an FY26 and 27 basis, also it trades at around 20 times and 16, 17 times on a 1-year forward basis. Next slide, please. Pramod. So just in terms of the contributors and detractors, again, as I said, like in a market where the overall broader benchmark was down, we had few names like SBI Cards and Interglobe Aviation, which were reaching their 52-week highs. And again, there are a few detractors in terms of Jubilant Life Sciences, Jubilant Pharma, Varroc Engineering, and Gujarat Pipavav, which again, the correction is giving us an opportunity to add it into newer set of investors which have come in. If we were to talk about the performance, Pramod, next slide. Over the last 6 months, where we have seen the market draw down close to 12%, the performance of the strategy has been relatively better, wherein the drawdown has been lower at around 11%. And again, in the month of Feb, where we saw the recovery happening, the performance has been in line. So versus what we have seen in the market, the performance of the strategy has been relatively better. And the endeavor has been that when the markets draw down, our drawdown should be relatively lower. And when the bounce back happens or the recovery happens, we should try and outperform the market. Talking about the Jasmine, which is again an offshoot of KWB, there also, Pramod, next slide, please. There also, again, the allocation largely remains similar. Healthcare continues to be the largest holding, followed by consumer discretionary, financials, and communication services. And here as well, as I said, we are anticipating around 20% plus sort of an earnings growth over the next between say 24 to 27. If you were to take it for a 2-year period between 25 to 27, the earnings growth will still be higher at around 24-25%. And again, valuations are relatively at comfortable levels for us. For Jasmine as well, because it's a replica or an offshoot of KWB, the contractors and contributors and detractors continue to be the same. Next slide, please, Pramod. Largely being the same, wherein Elevis Life Science, again, stock which we added sometime last year at the same time, that has also continued to do well for us. And in terms of performance, which is there on the next slide, so Jasmine also did well, I would say, in the last 6 months. Next slide, please, Pramod. So over here as well, if you see, versus 11.8% drawdown, which we saw for the benchmark, Jasmine was down around 12.5%. And the recovery also has been good in the last 1 month or so. I'll hand it over to Ekta and then we'll take questions at the end. Thank you.
Thanks, Vinay. Thank you everyone for joining us today. So I'll first briefly talk about Magnolia. Magnolia is a large and mid-cap focused fund. The idea behind launching this fund was to basically burst the myth that, in large caps, you cannot generate alpha. And this perception, of course, is not unjustified. We have seen mutual funds with large cap portfolios not beating the benchmark on longer time frames of 3 to 5 years. And we've seen mostly this is because most of these funds would have a portfolio which is very index hugging. and hence the ability to beat the benchmark goes lower. And that is where we come in through Magnolia, where we are not afraid to take bold calls. Even in the large cap space, we are able to find names which fits our philosophy of growth at reasonable price. And this kind of is corroborated in, if you can look at it from a sector weights perspective. So we are significantly underweight in financials, and even in financials we would have differentiated names which are in our top holdings, which would be SBI Cards or an HDFC Life, which we've already discussed. Even healthcare, we are significantly overweight compared to the benchmark. Benchmark would be at 4-5% and we are at 17-18%. So this kind of differentiated calls, even consumer staples, if you see, we have no holdings in consumer staples versus a 6-7% index weight. So this is the perspective from where we would find differentiated names even within large and mid-cap space, where we feel that these names are available, though well discovered. The whole narrative around these names right now, not what the consensus view is, and we feel that the growth prospects for these companies going forward would be much better. And that is where we come in through our Magnolia portfolio, which again, despite being a large cap portfolio, would be very concentrated of about 20-25 names, and we'll be able to generate alpha through these differentiated companies. So if you look at the portfolio stats table below, you would see that we expect the earnings of these companies to be in the 18-19% range over the next 3 years, with ROEs of more than 20%, but still available at reasonable valuations of 20 times, 21 times, 26 and 18 times in FY27, which is much lower compared to the benchmark index. In terms of allocation, in terms of large and mid cap, you can see that large cap is more than 60%, and we also are, if you look at it, the cash holding is also a little higher at 10%, which gives us some room to add few names going forward. Next slide, please. So yeah, in terms of contributors, detractors, again, fairly similar names that we have talked about earlier. So SBI Cards, HDFC Life, these are among our top holdings, and they have done well in the last 2-3 months. Bharti Airtel, again, phenomenal set of numbers in this quarter, which has helped the stock to perform better compared to the index. And in terms of detractors, of course, these are the smaller names that we have in our portfolio. Next slide, please. So yeah, the performance, as you can see, over the last 2 years and since inception, we have done very well. In the last 6 months, when index is down 8.5%, we are down 9.7%. Of course, if you look at it from a broader market perspective, the 500 is down much higher. So just to highlight, Nifty 50 might be down 8.5%, but next Nifty 50 is down much higher. So the whole large cap index would be both Nifty 50 and the next Nifty 50, just to give a perspective on the large cap index overall. Next slide, please. So yeah, Lotus again. Here, Lotus, to give a brief on this scheme that we have launched over the last 2 years. Here, it is kind of a mirror where it is more small and mid-cap heavy compared to Magnolia, which is more large and mid-cap heavy. So if you can see the allocation, the small and mid-cap allocation would be more than 70% right now. Again, we do hold some cash, which will help us in bringing in new names given the current environment. Again, sector weightage is very different from the benchmark. Consumer discretionary, healthcare, financials. You would see financials being much underweight and consumer discretionary and healthcare being much higher weight, corroborating the whole Karma philosophy through the stocks that we hold in our portfolio. If you look at it at the bottom table here, even here, the earning momentum continues to remain strong, even in a small and mid-cap portfolio of more than 20% CAGR. But the valuations still continue to be reasonable at 20 times 2 year forward at FY27. Next slide, please. So yeah, again, the contributors here, of course, NH, we added this name we have been holding this name for some time, but we increased the weight significantly 3-4 months back, and it has kind of played out very well for us. Interglobe, of course, has done very well for us, and life insurance name. In terms of detractors, of course, the similar kind of names of Gujarat Pipavav and Jubilant Power. Next slide, please. So again, performance clearly reflects the kind of names that we have. While it is a small and mid-cap heavy, we have been very conscious of the kind of names that we have. We are not paying very high valuations for the stocks that we hold, even in small and mid-caps, and which is kind of reflected in our performance through across time frames. Next slide, please. Yeah, so I think that's about it in terms of presentation. Happy to take any questions.
Hi everybody, this is Rushabh here again. We are very happy to take any questions you would have on the portfolio, on our positioning, on any of our schemes. Very happy to take that.
There is a question in the chat box talking about what is the AUM in Jasmine and Magnolia.
Jasmine and Magnolia are very small for us right now. From our perspective, these are schemes where we are more seeding. Jasmine was actually an offshoot of Karma Wealth Builder. Karma Wealth Builder is our flagship, where majority of our AUM is there. Our AUM is today about 6,500 crores. Most of which is in Karma Wealth Builder. Jasmine, we started as an offshoot for Karma Wealth Builder. And Magnolia is something where we are building a track record. As Ekta mentioned, there is, when we talk about large cap in PMS, there is a lot of apprehension. We believe that over time, there is an opportunity to be able to generate significant alpha in large caps. And Magnolia is, from our perspective, going to be a demonstrator for that. So what we have done is we've seeded the scheme and we are building a track record. At a point of time, once we are ready, we will take this and kind of start going out and raising more capital in it. But right now, these are very small from a AUM perspective. Cycle, you identify cycles early. So where do you see the early trends? I think there's another question. You identify the cycles early. So where do you see early trends? As I mentioned, from our perspective, we believe that life insurance is something where after a lot of regulatory interventions over the last 5 years, if you look at, say, HDFC Life, you until about a month ago, you were not making any money over the last 5 years. And that's primarily because of the derating. Of course, the underlying EV had doubled in that 4 years, but the stock had got derated. We believe life insurance has a very strong organic growth potential, and it's at an early cycle stage where we think life insurance is where maybe private banks were about 10 or 15 years ago. So from our perspective, life insurance payments is another opportunity where we see a significant runway for growth. Payments as a part of the economy, and also payments is highly consolidated. So if you look at life insurance, if you look at payments, it's been significant consolidation in these industries. We believe these are the companies or businesses where we are at an early stage of growth, and there are maybe many years of growth ahead of us. There is one more question. All macro and micro factors are not indicating a very positive first quarter. Do you think it will be a good time to be in the market? Would it be a good tactical move to stay in cash or invest in debt, where we are able to give 8 to 10% from a risk-free? Any views on that? So from our perspective, a lot of froth is getting taken away. It's very difficult to time the market. It's not going to be possible to get a bottom of everything. We believe some of the stocks have bottomed out. I'll give you an example from our perspective. SBI Cards, which we have been holding for now about 3 quarters, reported their worst quarter in many quarters in the third quarter. And because people thought now that it's past the hump in terms of provisioning, the stock is actually up 20% since then. So from an investing perspective, it's going to be very difficult to time it. Yes, first quarter is going to be slow, but now that everybody knows that, it's not anything new. From our perspective, it's more how you're positioned rather than trying to time the market in terms of whether first quarter will be good or not. Our view of the world still remains the same. Everything will not bottom out at the same time. Stocks will start bottoming out, and which we think some of them have already done, and will start to move up. So our job is to identify those ideas, not really worry too much about the macro. Macro will do what it needs to do. What is the overlap between the 3 strategies? I will ask Pramod, can you hear us? Or Vinay or Ekta, if you want to jump in. But the overlap between strategies, the 3 main strategies, which is all cap, small and mid cap, and large cap, is about not more than about 30-35%. So there is a very different stocks up to the extent of about 60-65%. In fact, for small and mid cap, it will be even higher, because there the number of companies that we have is more like 30 to 35 instead of about 20 to 25 in our flagship portfolio. Vinay, Ekta, you want to give some color on the overlap?
Yes, so again, within, as mentioned, so within a flexi cap and a large cap, although the names might be similar, the weights would be different. And as Rushabh rightly said, the overlap would be ideally below 35%.
There's another question. Sorry, Ekta, you want to add something?
No, I just wanted to say, if you look at even the market cap cutoffs, you would see that the flagship would have about 30-35% in large cap, whereas the large cap focus would have more than 60% in large cap. So that itself will show you, reflect the differentiation in terms of the stocks that we own between the three portfolios. Similarly, same applies even for Lotus.
There's another question. What is the general holding period you have for any conviction bets in your portfolio? Our average holding period today is running at about 5 years for our flagship Karma Wealth Builder. That's a reasonably long time to own anything. The longest that we have owned, one stock that we have owned is more than a decade now, almost about 11 years. And our average holding period is about 5 years for Karma Wealth Builder. The other two strategies are still young, with a track record of maybe less than 3 years. So from that perspective, that's not much we can add there. But from a flagship perspective, it's about 5 years, which is what we have written in the presentation as well. Tough, you are long-term equities, but would you like to know your views on precious metals from here? Honestly, we are not experts at precious metals. Gold has had a great run. But, as I said, it's beyond our pay grade to really comment on precious metals. We don't really know where they're going, and we really honestly don't care too much because we don't look at it very closely.
Piyush had a question earlier. He's asking, what is the maximum allocation in a single stock for us?
Oh yeah, sorry, I missed that. The maximum allocation, generally we don't buy at the time of purchase, we don't buy more than 6 to 8%. Of course, then there might be some price appreciation and it might go up and we will trim it back. So from our perspective, we generally don't, our hard-coded limit is 10% for each stock, single stock, but generally we would buy between 6 to 8%. And that also has to be a large cap. If it's a small or mid cap, based on liquidity and the size of the business, we might not exceed maybe 3 or 4% in those names. So based on the size of the business, anything between say 2.5-3% to about 6 to 8%.
There's one question by Aditya in the Q&A section. He's asking about Narayana being one of our focused holding, has been planning to enter health insurance business through their brands Arya and Aditi. How do you see this shift from NH, and maybe a brief view on the insurance sector as well?
So maybe Ekta tracks both of them. I will hand it over to Ekta about Narayan as well as the life insurance.
Yeah, so Narayan, while has entered the health insurance, it's still very early stages for Narayana. Through the brands like you mentioned, they have invested about 100-150 odd crores in this. Still very early stages for them. Let's see how they are able to increase focus on the health insurance side. On the hospital business, however, over the next 2-3 years, what we are seeing is they are planning to increase their capex over the next 2 years, and the majority of the bed addition will happen FY27 onwards. Over the next 2-3 years, we'll see majority of the capex come through in the balance sheet, and then of course the revenue and the margins will start contributing from FY27 onwards. Within the hospital space, of course, Narayana is among much fairly valued compared to the other hospital chains, and we believe that the growth going forward will be much stronger for Narayana compared to the others. The Cayman facility, of course, is after the expansion will also start contributing to the growth going forward. On the health insurance space.
No, life insurance, Ekta.
Yeah, so on the life insurance space, so like Rushabh mentioned, we have been very bullish on the life insurance side, given the overhang that we had seen over the last 2-3 years in terms of regulatory thing, whether it was the surrender value charge changes or the whole composite license, and now we are hearing the impact of the banca channel being constrained. All of these has led to significant derating of these life insurance sectors. What we believe is that they have reached an inflection point where we should see growth being much stronger. And that is what we have seen in the FY25 year, where we have seen the growth being much stronger for the industry overall, especially, and for HDFC Life, they have gained market share, meaning that they have grown faster than the industry. Apart from the growth being better, we also believe that the margins have kind of bottomed out. So one was the impact of the ULIP being at a higher segment mix, which was pulling down your overall margins. We believe that we have reached a point where we should start seeing margins improving going forward, which will help in improving profitability. HDFC Life, of course, to talk more specifically, we have seen historically they double their EV every 4 years, which is more than and which is around 18 to 20% CAGR. And even if that happens, we should see good returns in that stock.
Yeah, only thing I would like to add in life insurance is that when we talk about life insurance, everybody thinks that this is driven by tax savings as a major criteria. I would like to point out that if you talk to any life insurance company in the private sector, they will tell you that almost 90-95% of the policies are now not bought for tax, and therefore it's now an organic growth coming from market-driven approach, not because somebody wants to save tax. So I think the dynamics of the business have become much better over the last 5 years. The policy intervention, a lot of it is behind us, while the underlying growth continues to be in place. Structurally, these companies will keep gaining market share at the cost of the government sector, as well as you will continue to see consolidation. So the top 4 or 5 companies will continue to gain market share over time. So I think a perfect recipe from our investment perspective, consolidating business, margins bottomed out, growth intact, and very secular growth opportunity over the next 5 to 10 years. Are there any more questions?
Yeah. So
go
ahead, Ekta.
Yeah, so there's a question from Shivam asking that we have a very high active share, but performance is still in the 1-2% axis of benchmark. Is it because of the limited time frame that we are looking at, and what would be the overlap between different strategies? So second question, I think we already answered in terms of overlap, would be around 30-35% between different strategies. In terms of performance on the large cap side, so yes, you're right, we run a significant higher active share. Active share would be it would be around 70% for Magnolia. The reason why you're seeing at 1-2% excess of benchmark is you have to also look at it that you're looking at one point in time. Maybe a 2-month back, you would see a much higher alpha. So that, of course, and of course, the smaller time frame of less than around 2 years also kind of plays out. I'll also highlight that we are holding some cash at this point in time. So as we will see these play out over the next 2-3 years, we should see that improving.
We have more.
Karan has a question. So we just want to know our opinion on the hospitality and hotels business.
Hospitality and hotels, I think from our perspective, we did own Indian hotels at some point of time, but we just believe that now the valuations on some of these companies are very expensive. And also you are pretty much at the top of the cycle. So if you look at the cycle, you've seen the average rates go up over the last 3-4 years post-COVID significantly in India. And if you look at Indian hotels today, I think at least as a customer of these hotels, that the Indian hotel rates are significantly more as compared to many other countries, including in fact in many cases even in Europe. And therefore, the interesting way to play it is that, and as we keep joking about it, the more Indigo starts opening up international routes, the more people will travel because you're getting hotels cheaper. So for example, Phuket or some of the Thailand destinations or some of the destinations in Vietnam, or for that matter, even in Eastern Europe, actually have hotels rates which are much more lower. So if you have cheaper flights and direct flights available, a lot of people will fly out into some of these destinations. So from our perspective, a lot of the best is behind them in many ways. You're not going to be able to see any further increase or significant increase in room rates without seeing a damage in the demand. We also believe that as economy slows down, you are starting to see that impact a lot of sectors like passenger vehicles, two-wheelers, consumer staples. My sense is that you will also start to see that if the slowdown continues for a couple of quarters in hotels as well. So from our perspective, we did own Indian hotels at one point of time, but we believe that now we are at a point where we can't justify the valuations at the current point of time in the cycle. All right, guys, if you don't have any more questions, we would like to end the call today. So just one last time, if anybody has any questions, happy to answer them. Otherwise, we will end this call and we'll come back to you next quarter.
There's a question from Lan. He's asking if we continue to hold Z.
No, we don't have Z for the new investors. For some of our old investors, we do own it, but we've not bought it since the merger was scrapped about a little over a year back now. Anything else?
No, I think we're done.
Yeah. All right, guys. Thank you so much, everybody, for patiently listening to us. Thanks for joining the call. We really appreciate your taking time out and getting onto this call today afternoon. Thanks, you guys. Have a great evening. Thanks you. Thank you.
Thank you.